Good morning, traders. This is Evelyn from Astra Montis, and I'm here to bring you the latest insights for the week of June 17th to June 21st, 2024. Let's dive into what to expect in the upcoming week. This week, we're diving into a dynamic landscape where central banks, economic data, and political developments are shaping global markets. From the Reserve Bank of Australia navigating inflation pressures to the Swiss National Bank's upcoming decision on interest rates, and the Bank of England's cautious stance amidst UK election dynamics, there's plenty to unpack. The Reserve Bank of Australia faces tough choices at its June policy meeting amidst a murky economic outlook. Despite hopes for smoother conditions, persistent inflation and mixed economic signals complicate policy decisions. Inflation had get up to 3.6% year-on-year in April, reversing a previous decline, while the labor market tightened. However, doubts about overall economic strength led policymakers to hold off on a rate hike in May, a stance likely to continue in the upcoming June statement. Although investors have shelved expectations for rate increases recently, Australia's inflation challenges suggest caution. Any policy shifts are unlikely before August, pending new economic forecasts. The timeline for inflation returning to the RBA's 2 to 3% target range will shape future rate decisions, amidst ongoing uncertainty domestically and internationally. The Swiss National Bank SNB surprised investors with a rate cut in March, marking the first move by a major central bank in this cycle. Ahead of its quarterly meeting on Thursday, markets speculated about a two-thirds chance of another 25 basis point cut. However, recent data shows no immediate need for further easing. First quarter GDP exceeded expectations, and inflation held steady at 1.4% in both April and May, with an inflation target of 0 to 0%, and considering the weaker Swiss franc, policymakers may opt to delay further cuts. Outgoing President Thomas Jordan has cautioned against premature action, highlighting exchange rate dynamics as a potential driver of inflation risks. The Bank of England gears up for a quiet policy decision amidst ongoing UK election sensitivities, prioritizing political neutrality to avoid influencing voters. Policymakers await upcoming economic data following April's CPI drop to 2.3%, juxtaposed against resilient 6.0% wage growth and persistent services inflation. Despite signs of a softening job market, including rising unemployment rates, any policy adjustments are likely deferred until August's new government and updated economic forecasts. Focus shifts to Wednesday's CPI release, Friday's retail sales figures, and June's flash PM is for economic insights. Market expectations hint at a 40% chance of an August rate cut, with full pricing for a 25 basis point reduction potentially delayed until November. A May CPI dip below 2% could prompt earlier easing speculation by the Bank of England. It's been a tumultuous week for Fed observers, beginning with a soft CPI report followed by a hawkish Fed meeting. The dollar's volatile journey started with a robust jobs report, culminating in Treasury yields ending at their lowest in 2.5 months. Market expectations have oscillated between 1 and 2 anticipated rate cuts, with the recent dot plot indicating just one cut for 2024, which didn't significantly alter sentiment. Fed Chair Powell, however, hinted at a possible September cut if inflation continues to decline. Moreover, Fed projections for 2025 now anticipate more cuts compared to March. Tuesday's retail sales data holds significance as it could dampen current optimism if it reveals accelerated consumer spending in May, with forecasts expecting a 0.3% month-on-month increase following April's stagnant figures. The euro faced volatility recently following gains by far-right parties in the European Parliament elections, and French President Macron's surprise announcement of snap elections, A brief dollar sell-off provided temporary relief for the struggling euro. Looking ahead, the euro's stability hinges on Friday's flash PMI figures, which could offer support if they show an upbeat economic outlook for June. Positive surveys would diminish expectations of further ECB rate cuts in the near future. Investors will also scrutinize Monday's quarterly wage data, Tuesday's final CPI estimates for May, and Germany's ZOE Economic Sentiment Index release, all key indicators influencing the euro's trajectory. This week in Japan, all eyes are on Friday's release of May inflation numbers, which are poised to influence the yen's performance. Additionally, Tuesday's trade figures and flash PMIs will draw market attention. The Bank of Japan recently opted to postpone any decision on scaling back its bond purchases until the July meeting. This cautious stance contributed to a decline in the yen's value. However, there could be positive developments for the currency stemming from the upcoming CPI report. Analysts anticipate the core inflation figure to rebound to 2.6% year-on-year in May from 2.2%, potentially strengthening the case for the BOJ to continue scaling back its stimulus measures. Meanwhile, the New Zealand dollar will be in focus on Thursday with the release of the first quarter GDP data. At the beginning of the week, market sentiment will be set by China's monthly data release, encompassing industrial output and retail sales figures on Monday. This week has been marked by pivotal decisions and economic indicators across major economies, from the Reserve Bank of Australia's careful deliberations amid persistent inflation to the Swiss nation, our bank's measured approach on interest rates, and the Bank of England's cautious stance amidst ongoing political uncertainties. Each central bank faces unique challenges. Meanwhile, market focus remains keen on upcoming data releases such as U.S. retail sales and Eurozone PMI figures, which will provide further insights into global economic health. Stay tuned for ongoing updates as these developments continue to shape market sentiment in the weeks ahead. To conclude, as we navigate through this week's trading landscape, it's essential to closely monitor these significant updates. We appreciate your confidence in our insights and wish you prosperous trading in the days ahead.